Welcome to Griffonomics.
Right into it today, yeah.
Oh, absolutely. So,
Yeah.
right now, the world's most advanced AI processors, they spend over half their time doing absolutely nothing.
Just sitting there.
Literally just sitting there, burning power, waiting for data to arrive. So today, we're taking you on a brand new deep dive into the actual engine room of the AI boom, which is the memory market.
Yeah, and it's the absolute definition of a critical structural bottleneck. I mean, everyone is just staring at the processors,
Yeah.
right? Building bigger, faster computing brains.
All right, the flashy stuff.
Exactly. But the real constraint limiting AI performance today isn't, the ability to do math. It is what the industry calls the memory wall.
The memory wall.
Yeah, the physical limitation of moving data from storage to the processor quickly enough to actually keep that processor fed.
And that bottleneck, that's exactly why we're looking at a very specific player today. We are unpacking a stack of sources for you: Q1 2026 earnings transcripts, Baird equity analyst reports, SEC 10K filings, and some strategic investment analysis.
It's a deep stack this time.
It really is, and it's all centered around one company, Rambus. Ticker is RMBS.
Yeah.
Our mission for this deep dive is to understand their transition from being a pure intellectual property licensing firm to becoming this semiconductor hardware powerhouse. We really need to figure out what this pivot means for the future of AI infrastructure.
And what's really fascinating here is that Rambus, they are not some new startup trying to, catch an AI wave.
Right.
They have over 3 decades of advanced semiconductor design experience, but they are currently executing this profound strategic pivot.
They're right in the middle of it.
Exactly. They are positioning themselves right at the intersection of where, unprecedented computing power meets the very stubborn laws of physics. They're trying to solve how we move data safely at speeds that were honestly considered impossible just 5 years ago.
Wow. Well, to understand how they plan to solve that, we have to look at how they afford it, right? Because the capital required for R&D in the AI hardware space is massive.
Oh, astronomical.
Right. So Rambus operates on this dual-engine hybrid architecture. Historically, they're known for patent licensing. And those foundational royalties, they still make up a highly stable 40% of their revenue.
Which is huge.
Yeah, we are talking roughly $200 to $210 million annually in pure licensing fees.
And we really need to emphasize the structure of those deals, too, because those are not short-term handshake agreement.
No, not at all.
These are long-term licensing contracts. We're talking up to 10 years with major players across the entire semiconductor ecosystem.
Wow, 10 years.
Yeah, it provides this high-margin cash floor. I mean, in an industry famous for wild cyclical swings, where memory prices boom and bust based on global supply, that royalty floor essentially insulates their research and development from market panic.
It's basically a trust fund.
Yeah, exactly.
Those 10-year royalty agreements act like a corporate trust fund, which completely changes their risk profile.
Yeah.
That steady revenue allows Rambus to operate with the aggression of a hardware startup, but without the financial terror of, missing a funding round.
Right, or barely surviving a market downturn.
Exactly. So they've taken that cash and aimed it directly at expanding into actual product revenue. They are building the physical interface chips now, which makes up 49% of their business.
And that represents a fundamental shift in who they are dealing with on a daily basis, too.
How so?
Well, Rambus used to sell primarily to the traditional DRAM memory makers, your Microns, your Samsungs.
What? The big legacy guys.
Yeah, so they were one step removed from the end user. But today, they are engaging directly with the hyperscalers.
Or the cloud giants?
Precisely. The hyperscalers are increasingly building their own custom silicon, specifically tailored for their proprietary AI software stacks. And to make those custom ASICs work, they desperately need Rambus's IP to handle all that complex memory bandwidth and connectivity. Rambus has effectively moved up the food chain.
Well, looking at their Q1 2026 balance sheet, that upward mobility is clearly paying off.
Yeah.
They ended the quarter with about $430 million in cash and zero debt.
Zero debt. That's a beautiful thing in hardware.
It really is. Which raises an interesting strategic question for you. With that pristine balance sheet and the dual-engine model firing, is this why management feels confident enough to aggressively buy back shares right now?
Yeah.
Even while funding all these new product lines?
Oh, precisely. Management evaluates that zero-debt balance sheet. They model out the steady cash flow from the IP royalties, and they see this structural explosion of AI demand.
Right.
By executing aggressive share buybacks, management is signaling that they believe Wall Street is currently undervaluing their transition into this high-growth hardware space. They're betting heavily on their own roadmap.
Okay, so that roadmap leads us directly into the technology they're building to shatter this memory wall. Because the demands on these systems, they're changing rapidly.
Unbelievably fast, yeah.
We're moving from simple queries into this era of agentic AI.
Right, agentic AI.
Yeah, so for you listening, this isn't just asking a chatbot to write a polite email. Agentic AI involves continuous reasoning, multi-step workflows where AI agents are constantly talking to other AI agents to solve complex problems in real time.
And that kind of continuous iterative processing places extreme demands on both memory capacity and latency.
They need so much more space.
Exactly. The processors are essentially starving. They can compute the mathematical models far faster than the memory modules can physically feed them the variables. The bandwidth it simply cannot keep up with the logic.
So to widen that pipeline, Rambus recently launched the industry's fastest HBM4E memory controller IP.
Yep.
And HBM stands for high bandwidth memory, which is that stacked memory you see sitting right next to the processor on modern AI accelerators. This controller just sets a completely new benchmark for throughput.
And what is crucial to understand about Rambus's position here is that they are not just reacting to the market. They aren't just building parts to fit an existing specification.
Right, they're ahead of it.
They actually sit on standard-setting organizations like JEDEC. They are literally at the table defining the future roadmaps and standards for data center memory architectures.
Wow.
Yeah, they help design the locks for the entire industry, and then they sell the most efficient keys.
I like that analogy. It's like having a massive V8 engine, the GPU, but you have a tiny clogged fuel line. Rambus is widening the fuel line.
Exactly.
But wait. During the earnings call, the CEO mentioned an interesting dynamic. He noted that as workloads shift heavily toward agentic AI and inference, the hardware ratio in the data center is actually going to shift back in favor of traditional CPUs.
Yes, rather than relying exclusively on power-hungry GPUs.
Right, so my pushback here is if the data center pivots back toward CPUs for these specific reasoning tasks, does Rambus lose their edge?
They absolutely do not. And honestly, this highlights the brilliance of their agnostic approach. The CEO pointed out that agentic AI requires a really highly diverse mix of processing. Training models on GPUs requires extremely expensive high-bandwidth memory. But the continuous reasoning and inference tasks, the stuff handled by traditional CPUs, that relies on standard memory modules, like DDR and MRDIMMs.
Ah, I see.
Yeah, and because Rambus is building the interface chips and controllers for all of these standards, they are effectively agnostic to the CPU to GPU ratio.
How so they win either way?
Exactly. If the data center buys more GPUs, Rambus licenses more HBM IP. If they use more CPUs, Rambus sells more standard memory controllers. They are positioned to win regardless of how that architectural debate settles.
That flexibility is critical. But the physical reality of how they're scaling their hardware revenue is even more compelling, I think.
Okay.
Let's look at what the sources call the silicon content multiplier.
Oh, this is the best part.
Yeah. Back in the DDR4 era, just a few years ago, Rambus basically sold a single buffer chip for a standard server memory module. It was very straightforward, single slot play.
Right. The electrical environment was relatively forgiving back then. So a single chip could manage the data traffic between the memory and the processor.
But now, as data centers transition to DDR5 Gen 3, the speeds are so extreme that the physics change entirely. At DDR5 speeds, data isn't just a clean, easily readable stream anymore.
Not at all.
It's like trying to have a whispered conversation in a wind tunnel.
Oh.
The signal noise is deafening. So Rambus doesn't just sell the microphone anymore. They have to sell the entire noise-canceling sound booth.
That's a great way to put it.
Customers are forced to buy full bundled chipsets from them now. This includes power management ICs and companion serial presence detect chips directly from Rambus, just to ensure the processor can actually decipher the data.
And that bundled approach, that's really just the beginning of the multiplier effect. The real catalyst, the massive hardware supercycle Rambus is waiting for, is the transition to MRDIMMs.
MRDIMM.
Yep. Multiplexed rank dual inline memory modules. These are designed to drastically increase both the capacity and the bandwidth of data center systems, but without changing the physical footprint of the server.
Wait, how exactly does multiplexing achieve that without making the servers physically larger?
Good question. So multiplexing essentially means taking two separate lanes of data on the memory module and combining them into one super fast lane right before it hits the processor.
Okay. Got it.
But to coordinate that intense level of traffic without data packets colliding or, corrupting, you need significantly more traffic hops.
More chips?
Exactly. You need advanced data buffers strategically placed across the entire module to choreograph the flow. That is why this transition requires Rambus to supply 3 to 4 times as many chips per module.
Wow. Okay. So you were taking the dollar value Rambus earns on a single memory stick and literally multiplying it by 3 or 4. Purely because the physics of multiplexing demands more hardware.
Exactly.
Management estimates this specific MRDIMM transition opens up a $600 million served addressable market.
It's massive.
Yeah, and on top of that, they recently announced a completely new architecture called the SO-CAMM2 chipset. This runs at blistering speeds, up to 9.6 gigabits per second.
But the revolutionary part isn't just the speed, right? It's that it takes LPDDR memory and puts it on a detachable module.
Which is a major architectural evolution. I mean, LPDDR stands for Low Power Double Data Rate Memory.
That's the stuff in phones, right?
Exactly. It's the highly efficient memory usually used in mobile phones or ultra-thin laptops, which is why it is normally soldered directly to the motherboard to save space and power.
Right.
But AI data centers, they're desperate for that low power efficiency because their power budgets are stretched to the absolute breaking point right now.
So they want phone memory in their servers.
Yeah, but the problem is you cannot solder memory directly to a server motherboard. Servers require hot swappable, upgradable components.
Oh, of course. If a memory chip dies in a server rack, you need to just pull the stick out and replace it. You can't throw away a $30,000 motherboard just because one memory module failed. Exactly. So Rambus figured out how to put that low-power mobile memory onto a detachable serviceable module.
That's brilliant.
Yeah, and to make it work, they integrated 12-amp and 3-amp voltage regulators alongside an SPD hub directly onto the memory stick itself.
Oh, wow.
Yeah, those regulators manage the intricate power delivery locally rather than relying on the motherboard. It basically blends mobile power efficiency with what the industry calls server-class serviceability.
It effectively expands their total addressable market into entirely new tiers of AI hardware and potentially even down into premium AI PCs.
Oh, absolutely.
But let me play devil's advocate here for a second and look at the actual numbers.
Yeah.
On the Q1 earnings call, management openly admitted that SOCAMM2 volumes will be, quote, very minimal throughout 2026.
Yes, they did.
So if the volume is minimal, isn't this just a narrative device, a hype story to keep investors patient while they wait for the real revenue to show up?
Well, it is a fair challenge, and management was very transparent that SOCAMM2 shouldn't be modeled for major financial impact in the immediate near term. But it is far more than just a narrative device.
Okay, why?
It is a vital strategic stepping stone. By proving they can make LPDDR serviceable in a rigorous server environment today, they are actively engaging with the top-tier AI players for the design phase of the next generation of data centers.
Locking them in early.
Exactly. They are planting a flag and securing the design wins in a completely new, total addressable market. The revenue harvest may be a year or two away, but the architectural lock-in, that happens right now.
Gotcha. Well, if the technology is that critical and the multipliers are that profound, you would logically expect the stock to just be soaring on a clean upward trajectory.
You would think so, yeah.
But Q1 2026 hit what management gently described as an air pocket. The stock experienced a technical sell-off. So let's dive into the Q1 financials and the gritty reality of semiconductor supply chains here, because it was not a perfect quarter.
No, it wasn't. The Q1 earnings miss was primarily driven by what management quantified as a low double-digit million headwind. They reported $180.2 million in total revenue.
Okay.
But the shortfall was not a demand issue. It was directly tied to a one-time partner quality and yield issue at an OSAT facility.
And just to clarify, an OSAT is an outsourced semiconductor assembly and test partner.
Correct. When you are pushing the physical limits of DDR5 speeds, the manufacturing tolerances are microscopic.
Right.
They had a specific issue with an older generation of DDR5 products at this assembly facility. The yield just dropped, meaning too many chips were failing the final quality checks, so they had to quarantine the batch and extensively rescreen the products before they could ship them to customers.
Which pushed the revenue out of the quarter.
Exactly. That delay pushed the revenue out.
But the CEO, Luc Seraphin, was adamant during the earnings call. I mean, he stated unequivocally that the OSAT yield issue is completely behind them and 100% resolved.
Yes, very firm on that.
Which leads to my next pushback. If the problem is completely fixed, why isn't the Q2 revenue guidance exploding back upward?
That is the big question.
Yeah, because management guided for an 11% sequential increase in Q2 product revenue, bumping it to between $95 and $101 million. I mean, that is a measured, cautious recovery. It is certainly not a snapback. What exactly is holding the revenue back if the product is clean now?
That is the multi-million-dollar question, and the answer pivots us directly into a broader macroeconomic crisis. It is no longer just a Rambus-specific problem.
Oh, really?
Yeah, it is an industry-wide supply chain reality. CEO Seraphin explained that while their specific OSAT yield issue is solved, the broader back-end supply chain is incredibly tense right now.
Tense how?
The lead times for packaging and testing components are stretching out significantly across the board.
What is driving that industry-wide tension? Like, why right now?
It is basically a perfect storm. You have surging, unprecedented data center demand for complex AI components, right? And that is colliding with a massive industry-wide push to shift supply chains out of China for geopolitical reasons.
Oh, wow.
When you have the entire global semiconductor industry trying to simultaneously relocate their assembly and testing facilities to new geographies, it creates severe bottlenecks.
That makes total sense. The infrastructure in those new regions must be overwhelmed.
Exactly. So even with their specific quality problem solved, Rambus is caught in the exact same traffic jam as everyone else trying to get chips tested and packaged.
And that traffic jam feeds directly into the skepticism surrounding the stock on Wall Street. Because when you review the analyst notes, there is a fierce bull versus bear debate playing out here.
Oh, very fierce.
Let's look at the external bear case for a minute, specifically the Baird equity downgrade, because they downgraded Rambus to a neutral rating. And their argument centers on a really fascinating dynamic: HBM cannibalization.
Yeah, this is a brilliant piece of macroeconomic analysis by Baird, honestly. To build the extremely complex, vertically stacked, high-bandwidth memory that NVIDIA and AMD's AI GPUs need,
Right.
the global memory manufacturers are frantically diverting their production capacity. Producing just one wafer of HBM consumes significantly more factory time and resources than standard memory.
So they're prioritizing the expensive stuff.
Exactly. Consequently, they are literally cannibalizing their standard DRAM supply lines just to feed the high-margin AI beast.
Which inevitably creates a severe shortage of standard memory.
Yes. Analysts expect this diversion of resources and the resulting shortage of standard DRAM to persist well throughout 2027.
Wow.
And this exposes a core structural vulnerability for Rambus, because Rambus is a unit-driven supplier.
Meaning they don't sell the memory itself.
Right, they do not sell the actual memory chips, they sell the interface controllers that go onto the memory module.
So if the global shortage causes the price of standard memory to skyrocket, Rambus doesn't capture any of that upside. They don't benefit from the high price of the memory stick itself.
Not at all.
But if the actual number of physical modules being shipped goes down because of the shortage, Rambus suffers because they are just selling fewer controllers. They take the hit on unit volume without the cushion of pricing power.
That is the classic unit-driven vulnerability, exactly. And to compound the bear case, there is a significant platform dependency here.
The Intel and AMD thing.
Yeah. We talked extensively about that incredible 3x to 4x MRDIMM multiplier that will drive their future revenue. The problem is, Rambus cannot force the data center market to adopt MRDIMMs on their own timeline.
Right.
They are entirely dependent on Intel and AMD rolling out their next-generation server platforms that are physically wired to support MRDIMMs in the first place.
And management openly admitted on the call that those specific Intel and AMD platforms won't ramp in earnest until 2027.
Which is a long wait.
Yeah, so Rambus is basically standing on the runway, holding these highly lucrative 3x content multiplier chips in their hands. But the Intel and AMD plans are delayed until 2027.
That's a great visual.
Which poses a critical question for you as you watch this market unfold. With DRAM makers cannibalizing their own standard memory supply to build HBM and the next generation server platforms delayed, does Rambus risk getting stranded on that runway? Or does their IP portfolio protect them during the wait?
Well, that is the central tension of the stock right now, and it's why the strategic rating is accumulate on weakness.
Okay.
The bears argue they are stranded in standard module purgatory while the world focuses exclusively on HBM. But the bulls, they look at the broader institutional maturity.
Like what?
For instance, Rambus recently formed a cyber risk committee at the board level to formally oversee artificial intelligence risks and data security.
Oh, interesting.
Yeah, that is the move of a deeply entrenched, mature enterprise, not some fragile hardware startup. The bulls look at that 40% royalty floor we talked about, the zero debt, and the fact that Rambus IP is actively being licensed for the very HBM production that is causing the shortage.
So they still get a cut.
Exactly.
Yeah.
Their portfolio is incredibly diversified. They are generating high-margin revenue on the IP licensing for custom silicon today, while they wait out the supply chain traffic jam for the hardware supercycle tomorrow.
Okay, so what does this all mean when we bring it together?
Yeah.
I mean, Rambus is navigating a classic textbook business transition, but they're doing it with a massive safety net.
A very comfortable net, yeah.
They're utilizing the financial security of a highly stable 40% royalty business to fund an aggressive leap into physical hardware. They have successfully shifted from selling single buffer chips to engineering full noise-canceling data center chipsets. And they are bracing for a profound MRDIMM transition in 2027 that will multiply their silicon value per server by 3 to 4 times. But in the short term, they're battling an incredibly tight global supply chain, the geopolitical complications of migrating assembly out of China, and the reality that their own customers are cannibalizing standard memory supplies to chase that high-margin AI dragon.
It is a transition that requires immense patience from investors, without a doubt. But, analyzing Rambus forces us to fundamentally rethink the architecture of AI itself.
How so?
Well, I will leave you with a final thought to mull over. We have historically assumed the processor was the undisputed king of the data center, right?
It's atrocity.
But if AI workloads continue to force memory to become completely modular and complex and custom-built just to handle the immense power and signal integrity demands, well, the traditional memory makers might not be the ones holding the keys to the kingdom anymore. Yeah. In a few years, standard-setting IP architects who solve the actual physics of moving data might be the true gatekeepers of data center real estate. It makes you wonder, as artificial intelligence evolves, who really controls the future of the server? Is it the engineer who builds the processor or the architect who controls the data flow?
Risk defined, portfolio protected.